Welcome back, and thanks for joining me for the last in this series dedicated to remortgaging. We've looked at different types of mortgages, how to understand the impact of interest rate rises, and whether remortgaging is right for you or not. But there's one other question that often crops up, and that is whether it's worth taking out mortgage protection insurance. This is a type of income protection that will cover your mortgage payments for you if you're out of work due to an accident, sickness, or unemployment. You can apply for mortgage protection if you're employed, self-employed, or a contract worker. But providers vary, so always check carefully that you yourself will be eligible in your own situation. There are different levels of cover on offer, but generally it will meet the monthly cost of your mortgage and pay out for a year. It's not a legal requirement with a mortgage, but some lenders do ask you to have it as it provides protection for them as well as you. If your lender doesn't ask for it, whether you insure or not is really down to whether you would appreciate the peace of mind that it offers. A good question to ask yourself is, if your income stopped tomorrow, could you afford to make your mortgage repayments? If you have doubts, it's well worth looking into mortgage protection insurance. Failing to keep up with mortgage repayments can result in your home being repossessed. So everyone really does need a safety net, whether that's savings or insurance. There are three main types of protection policies. There's income protection, which replaces some or all of your regular income if you're unable to work. It will pay out for a set amount of time or until you're fit to work again. Critical illness cover can be bought for a lump sum and covers you if you fall seriously ill. And then life insurance gives a lump sum to a nominated individual if you are no longer around to support them. The cost of mortgage protection insurance varies according to your age, your occupation, your health, and your lifestyle. The cost is also driven by how much cover you want. If you have a joint mortgage, often both parties will take out the insurance, but you don't have to. If one partner's income covers all of the cost of the mortgage, there's no real need to insure the second person. But if you rely on both incomes, it does make sense for you both to be insured. And in fact, joint mortgage cover sometimes works out cheaper than two individual policies. Remember too, that there's sometimes a waiting period between you becoming unable to work and when the payouts actually start. If there is, you should have savings to cover that period. You can find links to more information about mortgage protection in the description below. I really hope that you found this series helpful and interesting. Do make sure that you subscribe as we upload new content all the time. You can then stay up to date with all things property related. I look forward to seeing you next time. Please do remember that your property may be repossessed if you don't keep up repayments on your mortgage. You may have to pay an early repayment charge to your existing lender if you remortgage, and individual savings may vary. Your savings will depend on personal circumstances.